great future. We're talking real money.
All right, I don't mean to complain, but the questions, the recorded ones, they've been a little light lately. We've done a lot of bobbing. There's a lot of bobs, but not a lot of the rest of yous. So today, got to keep some powder dry. And really not even enough for another show. I got to do it with a few questions, one fewer than usual. So hopefully, though, you'll enjoy them, as I did. And by the way, these questions came to us via our lovely website, talkingrealmoney.com, where you can click on the Contact Us button and say, I want to ask a question, and type it in, or you can go down to the lower left-hand corner and record your question using the mic on your phone or the mic on your computer or your tablet or whatever you have. So go do that and send those things in, and I will answer them on the Friday podcast. That's when these get answered. The written ones, they get answered all over the place. But the spoken ones, they almost always, they're on Friday, and that's what this is, the Friday podcast. Oh, by the way, I'm Don McDonald. I'm one of the hosts of the Talking Real Money podcast that has lived on for ages and hopefully will continue to. Thanks for being with us, and send those questions in at talkingrealmoney.com. And now let's get one of those questions, insert it here into the recording timeline, edit it as necessary, and then I'll answer it.
Tom and Don, Chris here. I'm a long-time listener and a first-time caller. Listen to you all on the podcast. I'll go ahead and jump into my questions. I have about 2, maybe 3 questions. I work for the city of Seattle and planning on retiring around 2040, maybe a little earlier. And the options that are provided by the city are somewhat limited, but at least they do have, I do have access to the Vanguard portfolio. So currently, my allocation for investment is about 21% in the total bond market, about 51% in the total international stock market, and about 28% in the total stock market. As you can see, that I'm pretty heavily vested in international. I want to get your thoughts on that. Am I being maybe a little too influenced by what it feels like a historic pivot that we are sort of living through and may look back on and see the markets a little differently? Curious what your thoughts might be on that.
Well, one of the big benefits of doing questioning this way and answers this way is that I can break the question up and address each piece along the way. Like this first question. Holy mackerel, you're overweighted in international. I love international, but I don't love it that much. I just want it to be its relative share of the market, close to it, somewhere between 30 and 50%, because over time it's been somewhere between 30 and 50% of the global economy. So, somewhere around there. Yours overkill. You are, wow. You are like, you really probably have twice the international you should have, or close to it. And I know why you're doing it, because and I know you think it's logical, but trust me, it's not. What you're doing is you're allowing feelings to drive your decisions, because it feels uncomfortable. It feels different this time. It always feels something that is going to drive you to make decisions that often aren't good ones. Yeah, sometimes you're going to be right. And the problem is those times when we're right, well, we overweight those in the future. We go, well, I called that one right. And you forget about all the ones you thought about calling and didn't tell anybody, but they were wrong. Remember, the market knows actually more than you do. The prices you see today are based on every bit of knowledge and all the feelings you have times millions. So you don't know something nobody else knows. So for that reason, you just want to own the market, not too much international. Now on to the rest of your call, questions, whatever.
Separate but related, I could invest in just a target date, which would be like the target Retirement 2040 Trust one. That actually is invested or managed at 0.07 expense ratio, so it's like a 0.01% cheaper. But of course, it's not allocated in the same way. I think they have it at about 45% right now for total stock market, about 31% on the total international, about 17% on total bond market, and then about 6 or 7 on the international bond market. So it's a different allocation, and obviously it changes as time goes on. Curious if you think it makes more sense. This is of course not allocated the way that I've been doing it, but just what your thoughts are about target date. And I guess my final question relates to sort of the other options that are available, that I have available to myself. They do have a Vanguard S&P small cap 600 index. There's also a mid cap 400 index. All these are Vanguard. And there's also a Vanguard US growth large cap. There's the 500 index large cap. And then the FTSE social index large cap. Yeah, those are ones I haven't really considered, but curious about your thoughts there.
Well, target date funds aren't sexy. They're really boring. They're dull. They're not properly aligned and properly allocated necessarily based on your situation and your risk profile. But the one thing they do really well is keep people from second-guessing the market while giving you a relatively balanced portfolio and automatically rebalancing for you, so you kind of keep the right asset allocation for your general point in life. You, though, you sound a little more aggressive. The bond portfolio is a little high in the Target 2040, which is fine. You might want to consider that. And then you mentioned some other funds. Now, most of those I'm not interested in. However, you mentioned the Vanguard Small Index. Now, what you could do is consider putting the bulk of your money in the target date fund and then putting a little allocation, maybe 10, 15%, into the Vanguard Small, or maybe 10 into that and another 5 into international if you want that international overweighting. So that's one way I would consider it. And again, the thing I like about the target date is that it rebalances for you and it sucks the emotion out of the portfolio. And it is emotion that's driving you to not have the potentially optimal balance in your portfolio. I mean, who knows what the optimal balance is. And now we're going to finish up your question.
The final thing I'll say, which is probably the most important piece of information besides when I'm planning on retiring, is my risk assessment. And I put myself probably in the high 60s to mid 70s. I'm really not swayed by what happens in terms of when I look at I look at my portfolio maybe once a year, honestly, sort of adjust things. I obviously am paying attention to some what I sense to be some major things happening right now in the world, and I know none of us can predict. We always say that, but other than that, where else it's not, I'm not going to start pulling money out. I'm going to keep putting money in, even when things drop. I figure it'll go up eventually, so I'm putting the max amount in that I can. So, curious if you can give me some thoughts based on what I've just shared. Thanks a lot for giving a little time to my rambles here. And I'll look forward to hearing your answer on the air. Take care. Bye-bye.
Well, you're halfway there. I think you've got the right attitude. You know that you're going to sit tight when the market goes down. The only component that seems to be a little shaky is your belief that we can kind of feel and see and sense things. Yeah, we feel and see and sense things, but they don't always mean anything. As a matter of fact, often when we feel the worst about the market is when the market is poised to go up, because all of that bad feeling has been building up in investors' positions for years. That's why the adage, the market climbs a wall of worry. So again, I think you need a portfolio that you're not going to mess with, that you are now determined you will maintain the balance of, along with that determination that you're going to keep investing even if the market goes down, which is a good one because you're still accumulating. So thank you so much for your question. Thanks for sending it in. All the rest of you can do the same thing at talkingrealmoney.com on the contact form. And let's grab the next one.
Hey, Don and Tom. This is Casey from Albuquerque. I have a question about life insurance. How much term, I know you guys are advocates of the term policies as opposed to whole life. How much term is needed in a dollar amount? Is it to replace 1 or 2 years of income, or are you thinking if my kids want to go to an Ivy League school, do I need to have enough for that? If you guys could help me out with that, I appreciate it. Thank you.
Well, like everything else, it's very, very personal. So you have to look at your life situation. If you were to die and your income stopped, how much would your family need until they could get back to a point where someone in the household was making enough money to cover what was lost by your passing? So, for example, if you have a spouse who does not work outside the house, what are their prospects for working outside the house? What's going to take for them to do that at some point? How old are your kids? Does that spouse need to be in the house? And then, if that's the case, if they need to take care of the kids, they're little and they're going to be taking care of them for a long time. You may need 5 or 10 years worth of your salary, worth of that the income you were providing that maintained the household. No, as for giving your kids an Ivy League college education, there are ways to get that. Life insurance is designed to take care of your family at a level that is just above sustenance. It is to keep them alive. It is an emergency fund, basically, in the worst case scenario. So sit down and look at your situation. It can be anywhere from a couple of years if you have a spouse who makes as much as you do and can make adjustments to the lifestyle, to maybe 5 or 6, 10 years of your income. It depends on your situation, as with most everything. Sorry to be vague, but there isn't an actual number. People will tell you there is, but they'd be lying. Let's go to our next question.
Hi, Don. This is Craig, formerly of Puyallup, now from the mountains outside Seattle. Got a couple of questions for you. First, I wanted to tell you I'm ecstatic that you guys are coming around on AVGV. When I called a few months ago, there seemed to be some skepticism, and I mentioned that it was kind of newer, but honestly, it came about 6 months after AVGE, so I've been in it since the beginning and been real happy with it. Real quickly, in my Roth, I got a little over $1 million in my Roth. My wife has a little over 100,000, so I'm a little more aggressive in hers. And my HSA are basically all the same, 40% AVGV, 30% AVGE, and then I have 15% AVNV and 50% DFAW. I know there's a little bit of overlap with DFAW and AVGE, but because of how they're managed differently, I think it's fair to have them both rather than DFAW. And my wife's, since she has less, I've got her in AVUV. But in my brokerage account, and I retired a couple of years ago with a broken back, so basically living off the brokerage account, and we have no debt and live very frugal, but got about 240 grand in there, and it's basically broken down of 40% AVGV, 40% AVGE, and then I've got 20%. I know you like the target date funds. I've never been a fan. I've never had bonds, but I've got AVMA in there instead for the remainder as my more conservative side, and I just wanted your take on that. I've mentioned it before. You kind of liked it. I don't know that it replaces a target date fund, but it does give me the bond exposure, and I've been pretty happy with it, but wanted to get your take on that as part of a brokerage account, and then your thoughts on the 4 funds I have in the after tax. So thanks a lot. Love the show. Bye-bye.
Thanks so much. Sorry about the injury you sustained. That's horrible. And for that reason, your portfolio scares the living daylights out of me. You, sir, are incredibly, almost off the charts aggressive from my perspective. And I think from most people's perspective, you've got a sizable chunk of your money in the most volatile and risky of all of Avantis's total market funds, AVGV, which, by the way, we like. Yes, you're right. We made a really interesting case for it. One of our advisors made a really interesting case for it for people who have portfolios at work that are probably too conservative, how that might overweight those. I think you're way overweighted in small value. And I kind of like that you threw the international fund in, the AVNV, to improve your international balance. But when I look at this whole thing, and I really step back and then consider your situation, truly answer this question for you. If your portfolio, both sides of it, dropped by half, and you didn't know for sure it was going to come back, how's that going to affect your lifestyle currently and your concern about the future? I just think this is all. I know you don't want bonds, and I don't know how old you are, but you are disabled. So you are in a position where the portfolio probably should start becoming a lot more conservative. Now, AVMA, that's their moderate allocation fund, which is kind of like it's Avantis's kind of risky balanced fund because it's only about 30% bonds. But you have and we're big believers in small and value overweighting, but I think your overweighting is, right now it's looking great for you, but what if it doesn't someday? Oh, Craig, you got me worried. You got me a little worried for that eventual, probably inevitable big old downturn that comes when we least expect it. I think I would be a lot more conservative as I'm rebalancing. But if you're comfortable, just consider yourself warned. You're a smart person, you know. Thanks so much for the question, for the call, for listening, and let's grab our last one for this Q&A day.
Hi, Tom and Don. My name is Jason. I'm calling from Pennsylvania. I'm going to be retiring in 5 years at the age of 59 and a half. At that time, I'll have the option in my pension plan to either take annuity payout with no survivor benefits. It comes out to approximately $36,000 a year, or I have the option of taking a lump sum of $500,000. As you can see, the yearly payout from the $500,000 is equal to about 7% of the lump sum. I know if I take the lump sum and follow the 5% rule, that is only $25,000. So $12,000 less. A little background, I like to generate approximately $75,000 after taxes in retirement. At retirement age, I hope by that time my 401k will equal about $1.2 million. So I'm trying to decide between the annuity and the lump sum. I did put the $500,000 lump sum into a Monte Carlo simulator I found online. I put 90% in Vanguard VT and 10% in BND. I selected a yearly withdrawal of $36,000 to match the annuity payout. And at the 10th percentile, it predicted my money would run out in 27 years. It also gave me a 25% percentile. It said the money would last for 30 years. I think I'm okay with both of those options. The bonus is at the 50th percentile and above, the 500,000 would actually grow, and therefore I'd probably have some money to leave to my children. So I guess my question is, does taking the lump sum sound like a good idea, or should I stick with the guaranteed $36,000 for the annuity? I think I'm leaning towards the lump sum just because if something happens to me early. This way, there's some money left over for my kids versus just taking the annuity with no survivor benefits. So if you have any opinion, I would like to hear it. Thank you. Have a good day.
Of course, it's my job to have opinions. I have lots of opinions. I'm a opinion-laden. I'm not a big fan of annuities. Now, there are some things in here that I want to kind of talk about. I am assuming that you're either divorced or a widower, because I didn't hear a wife in there. If there's no wife in there, then the single life makes sense. If there's a wife in there, the single life doesn't make sense, which means your payout would be much lower. But that's one part of the equation. The other thing I want to ask is this is just me. What are you going to do for the next 30 years? I hope you have an exciting retirement plan that you can afford, because 59 and a half, I mean, my gosh. I don't know what I would have done with myself if I retired at 59 and a half. I would have been bored out of my mind. But that's neither here nor there. Let's go back to the question of lump sum versus the annuity. Here's an interesting way to look at it. Let's sort of turn it a little bit. You said the difference between the $36,000 and the 5% flexible. Now remember, that means some years will be better, some years will be worse if you're taking 5% flexible out. But if you're taking 5% flexible out, you kind of make that Monte Carlo look like forever. It's very unlikely you could ever run out of money at a 5% withdrawal with the properly invested portfolio, as long as it's not all in bonds or all in CDs. If you got stocks, you're probably in really good shape. Take that $12,000 difference a year and divide your $500,000 by that. That's 41 years. I mean, literally, you could draw down, you could take 36,000 and slowly, just like the insurance company is doing, draw down that principal. But the insurance company is betting that 500,000 is going to make them much more money than they're going to pay out to you, which is another argument for a lump sum, because then you're playing the role of the insurance company as long as you can invest it properly and maintain that balance. If you can do that, then I am almost always in favor of the lump sum option. So unless a $36,000 income is critical to your plans, because you have the other money too, I would really be tempted to take the lump sum and build a really good portfolio in an IRA out of that. I hope that works for you. Thanks so much for your call. That's the best thing we can call it, is a call. It's the closest comparison. Thank you for your recorded statement on a website. And hopefully many of you, if you have a question, you will just go to talkingrealmoney.com and click on that contact button and record that question with your voice. Because as you can see, now that I'm using artificial intelligence to improve the quality, the calls sound really, really good. So go to talkingrealmoney.com, record your question, and we will try to use those on the Friday show. A few get left out, but not very many. Most get on. Thanks so much for listening. Tell a friend or two or 10. And send in those questions at talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.